So let's do an example now using the purchase, manage, sell model. Let's ask the eternal question, should a private equity firm purchase Super Containers Inc., which we'll call SCI for short. So max value is back in action again here, and now they're looking at another firm, which is Super Containers Inc. or SCI. So what does SCI do? It takes shipping containers. You might recognize this as formerly a shipping container. It converts them into pop-up stores and other commercial types of applications. This is a pretty stable business with stable future prospects, so slow to no future growth. It's again a well-managed family business, and it's offered for sale for 120 million. Okay, and recent operating information for the firm. We have an income statement here. So remember, it's a stable firm, so this will work for any year. Part of our modeling assumption here is going to be, again, the firm is stable. So revenue in any given year, 150 million. These are in millions again. Depreciation, other expenses, EBIT, interest, earnings before tax, tax net income. So they've got about a 10% profit margin here, which is, again, pretty good, especially for an industrial company like that. What else do we know about them? The interest is from a $70 million loan where they're paying pre-tax RD of 8%, and the tax rate is 35%. So here's the current market situation when max value is considering this. The overall market for purchasing small niche companies like SCI is in a deep slump, something not unlike maybe April 2020 in the middle of the COVID virus pandemic. Max Value notes that, irrespective, this hasn't impaired the performance of SCI or its future prospects. So SCI is still doing pretty well. And you could imagine in the COVID crisis, they could be making a lot of hospital annexes, COVID testing sites out of containers, things like that. So irrespective of bad market conditions overall, this company is doing very well. And Max Value believes, as a lot of people do in April of 2020, that markets will generally be recovered in about 2 years. So here's their strategy, given all that information. So remember, the project for them is purchase, manage, sell this company, okay? So they're going to start out by buying all the equity today for that asking price of 120 million, okay? And they're going to leave the leverage as it is, okay? So the company has a $70 million 8% loan, and they feel like that's about the optimal leverage for this company, so they're not going to touch that, okay? And then what they're going to do, being the opportunistic private equity folks that they are, is they're going to operate the firm for 2 years when they believe the market will have recovered. So clearly they're buying low and planning to sell high here, and their estimate for selling high is that in 2 years after the market has recovered, they will be able to sell the firm for $160 million. So that's not bad, 120 to 160, plus they're going to get free cash flows for 2 years along the way. So that's looking pretty good. All right, so let's look at the financing structure and some other things. Okay, so when they're buying the firm, so the debt they already have this existing loan of 80 million, and they're going to leave that unchanged. What else is going to be important here? The amount of money they're going to put in from their own pocket to buy this firm is 120 million, and they're going to get 100% of the firm's stock for that, okay? And so the total capitalization of the firm after it's purchased is 120 plus 80, right? Total capitalization is always D plus E. So they've got the D already, they've got their E they're going to put in, so the total is 200, okay? And the weight of debt we can compute from that, D over D plus E is 40%, and that means, of course, that WE is equal to 60%, right? Because WD and WE have to add up to 100%. So we can talk a little bit about the discount rates. The pre-tax cost of debt capital for them, let's put in pre-tax cost of debt capital is 8%, and that comes directly from the interest rate on the existing loan, okay, and someone has thankfully computed the equity cost of capital for us at 10.31%. And how did they do that? They used CAPM or something like that to get that. And the income tax rate of the firm is 35%. Okay, so here's some of the key data that we need for the firm here. Okay, so our job, okay, they're entrusting us once again, fools that they are, okay. Is this a positive NPV project for max value? So how are we gonna go for this? There are a lot of different orders that we could solve this in, but let's do it this way. Let's start by getting all the cash flows for the project. I wanna get all the cash flows for the project because once I have them, it's gonna be relatively straightforward to just discount them all and add them all up together. So the cash flows that we need are purchase price, sell price, and the free cash flow. This is going to be for 2 years, right? They're going to own the firm for 2 years and sell it. So there's going to be a cash flow end of year 1, cash flow end of year 2, and each one we're going to have to discount back to t equals 0 using our equity cost of capital. Let's see if we've missed anything here. Nope, I think everything that I've got down here, we've already discussed up here. All right, so starting to get these cash flows, the first one, the price they're going to pay for the firm is 120. And that's going to be, in this case, for 100% of the common stock. So Max Value will be the sole owner of the firm after this deal. Okay, now let's get the free cash flows from managing the firm, okay? And in general, as you know, for any future year, we really have to use this equation. But once again, with this steady state assumption, we can really simplify things. The net income in year 1 will be year 2, CapEx will be the same, depreciation will be the same, and if it's steady state, changing working capital is going to be 0, CapEx is going to match depreciation, and the change in debt, we already know, is going to be equal to 0. So what can we say? The free cash flow in each year is going to be the net income in I, and that's going to be the net income in any old year because it's steady state. So the net income is the same every year. And that's what I've got down here. Free cash flow in year I is just FCF E in general, and that again is just equal to net income. So our free cash flow, and here I've gone through the whole mess again for you so you can see it really does work out that the free cash flow is equal to the net income in this steady state case. So the free cash flow here, it's equal to our net income, and that's equal to 15.34. In this case, the as purchased is equal to the pre-purchase. And why is that? That's because it's steady state and they're not making any changes. They're not changing the leverage. They're not changing anything. Okay, so now the sale proceeds when they sell the firm. So that happily someone's already estimated from us. And this was done most likely using a PE analysis. And I'll talk about that a little bit more on the next page. And let me just put in here to make sure that's clear. Ratio analysis, okay. So we're ready to go. We have all the cash flows. They've given us the equity cost of capital to discount everything with. So really all we have to do is plug into our NPV equation. Okay, so this is going to be big. So we start off with minus 120. That's our price paid by equity in the beginning, okay, plus what's that free cash flow from operations? I forget, that's 15.34 over 1 plus, I need to also look up the cost of equity capital, it's back here somewhere, 10.31%, 10.31%, and that wants to be discounted back by 1 year, and they get another year of that, so that wants to be discounted by 1 plus 10.31%, and that's the one that they get, that's the free cash flow they get from year 2, And then the sale price is that 160, and that happens at end of year 2, just after they get the dividend. They wait till they get the dividend, and then they sell the firm the next day. That needs to be discounted back. Also, I just want to make myself a little more room here. And that's it for the NPV. Everything's looking good, and the answer there was 38. So that's the NPV of this project for these guys, including all the extraordinary assumptions we talked about along the way, steady state for 2 years, et cetera, et cetera. But you see the nice thing here, you can use the steady state assumption, and you don't have to make a perpetuity out of it. You can just say it's happening for a couple of years, stable market, that sort of thing. So anyway, we do all of that. We get a NPV that is greater than 0. Okay, and so this model is telling them very clearly to go for it. All right, so there's two reasonable, very simple, but also very reasonable analyses for buying a firm. The first one, where we used the perpetuity, was clearly very quick and dirty. But this second one is actually pretty good. If you have a firm that is relatively steady state, and you're buying it for a kind of short term, you're buying in a recession and you're planning to sell it in 2-3 years after a market recovers, the analysis that we did here for this company is actually pretty good and pretty reasonable. Okay, so last thing I want to talk about here is how max value estimated that 160. And remember I said that PE firms private equity firms use PE ratio analysis to do this a lot. So they use the fact that the PE ratio is the market value of equity divided by net income. So what did max value do in this case? They note that PE ratios fluctuate with market conditions, and that's definitely true. So the PE for any firm in a depressed market is going to be much less than its PE ratio in a good market. So in this depressed condition where the price was 120 for the firm, the PE ratio was only 7.82. What they did then was they looked up historical PEs of comps, of comparable firms in a good market. They pay for this database. They pay maybe $2,000 a year for this kind of database. So they look this up and they take the average of comps in a good market, and they find that in good market conditions for publicly traded firms like this, they have a PE ratio something like 10.43. Okay, then what do they do next? They assume that SCI's PE ratio will converge to this good number when the market recovers. Of course, it's not going to be perfect, right? But it should be somewhere around there, okay? And once they have the estimated PE ratio for 2 years from now, and they have the definition of what the PE ratio is, they can get an estimated sale price, right? So they just take the net income at time of sale times the good market PE ratio, 10.43. So that's 15.34, because remember, it's steady state firm. The net income's not going to change, times 10.43, and that's how they got to their 160. So with that, pretty much, I think you have the basics now of how to go ahead and estimate the value of an entity to owners in at least one sort of semi-realistic way of looking at it, which is completely represented by the example we just did here. So private equity firm type of thing, buy the firm, manage it for 2, 3, 4, 5 years, then sell it. And with that in our pocket, I'm going to leave you and look forward to catching up with you again soon.